The piece that went viral is from Citrini Research titled The 2028 Global Intelligence Crisis, and it's deliberately framed as a fictional macro memo written from June 2028. The core scenario is what it calls an AI-driven intelligence displacement spiral, where white-collar automation happens fast enough that you don't just get layoffs, you get second-order effects, which are consumer spending weakens, defaults rise, private credit tightens, and risk assets reprice. The central headline numbers, unemployment rising to 10% by 2028, with broad automation as the driver. It also modeled a major market drawdowns, a scenario where the S&P 500 falls 38% from peak levels, and what matters there is not the exact number. It's that the story links AI progress to financial instability, not prosperity. Now here's the part that made it real for traders. The market reaction was immediate, and it was concentrated in the exact categories the memo called out as exposed. Datadog, CrowdStrike, and Zscaler each fell more than 9%, and IBM dropped 13%, which they noted was IBM's worst single-day decline since 2000. DoorDash also dropped sharply, reported around 7% after the memo highlighted it as an example of a business vulnerable to agentic commerce disintermediate the middle layer. Overall, software and automation exposed names sold off while chip and infrastructure outperformed. US software shares were already down 24% in 2026 at the time of publication, and investors were crowding into the picks and shovels side of AI foundries, memory, and compute supply. And then there was the meta reaction. Because this memo spread so fast, it became a sentiment event. One well-shared critique even came from Citadel Securities, which reportedly pushed back hard on the memo's assumptions, basically saying it's an extreme left tail scenario, not a base case. But the pushback itself proves the point. A single viral narrative forced scenarios, institutions to respond. So what's the founder lesson here? One, narratives can move capital faster than fundamentals. And two, if your business looks like a middleman, a thin wrapper, or a workflow that an agent can bypass, investors will price that risk quickly. And three, the companies that can prove measurable value in production, time saved, cost removed, revenue lift, because that is what survives fear cycles.